Before beginning to amass wealth, you must first develop a wealthy attitude. But what does this mean? The fact is that diverse groups of individuals have distinct perspectives on the world and their circumstances. It's quite potent how we utilize our thoughts to either draw riches to us or push them away. Even Napoleon Hill published a whole book about how your overall financial status is affected by your thinking. Napoleon Hill's 1937 book, Think and Grow Rich, explains how having a positive outlook can help you attract money. Welcome to Good Lucks, a channel dedicated to inspiring you to expand your mindset, make general life breakthroughs, and realize your full potential to see what life has to offer. We may improve our readiness and alignment in generating wealth for ourselves and our families by altering the way we perceive and respond to the world. These statements appeal to the affluent mindset and help us understand how we may use our influence to improve both our own lives and the lives of those around us. In this video, we take a look at a variety of phrases that the rich use every day. Without further ado, let's begin. What is the cash flow of his business? The quantity of money that enters and leaves a business is known as its cash flow. Businesses receive revenue from sales and spend money on costs. Additionally, they might earn money via interest, investments, royalties, and licensing deals. It is crucial for determining the liquidity, adaptability, and general financial success of an organization. Positive cash flow is a sign that the company's liquid assets are growing, allowing it to meet commitments, reinvest in its operations, distribute profits to shareholders, cover costs, and act as a safety net against upcoming financial difficulties. Strong financial flexibility enables businesses to benefit from profitable investments. They also perform better during recessions since they don't incur the price of financial hardship. Asking about the cash flow of a person's business is a rich person's thing to say, as cash flow is important to what they can invest in or not invest in. Most poor people would usually not concern themselves with cash flow before the venture into any investment. This can also translate to how much wealth a person controls, and more inflow and outflow of money can also mean the difference between wealth and poverty. Bullet on the company's tab. A tax deduction is something you can take out of your taxable income in order to pay less in taxes overall. You can select between itemizing deductions on a schedule of your income tax return or the standard deduction, which is one deduction with a set dollar amount. It makes sense to itemize your deductions if the total of your itemized expenses exceeds the standard deduction applicable to your filing status. Mortgage interest, charitable donations, unreimbursed medical costs, and state and local taxes are examples of admissible itemized deductions. For wealthy people, this means they can pay for personal costs through their firm and deduct a portion of their taxes at the same time. Because of this, a wealthy person would frequently purchase everything under the name of his firm, including homes, cars, trips, and even basic necessities like food. I have more assets than liabilities. Your balance sheet can be broken down into two categories, assets and liabilities, in its most basic form. A company's assets are any possessions that have the potential to provide future financial gain. Your debts to other people are called liabilities. In other words, assets increase your wealth while liabilities decrease it. Liabilities reduce the value of and equity in your organization, but assets create value and raise equity. Your company's financial health is greater the more assets it has compared to liabilities. However, if you find that you have more liabilities than assets, your company could be in danger of failing. People that are wealthy genuinely are wealthy because they have more assets than liabilities. Rich people frequently discuss their possessions and the things that have made them wealthy. Rich people value their assets, whereas poor people typically have more liabilities than assets. What is ROI? ROI is a mathematical formula that investors can use to assess their investments and determine how well one investment has fared in comparison to other assets. An ROI estimate may occasionally be combined with other strategies to create a business case for a specific proposition. How well a firm is managed is measured using the overall ROI for the enterprise. A return on investment may be determined by determining whether one or more of an organization's immediate goals, such as increasing market revenue share, developing infrastructure, or preparing the company for sale, rather than by determining immediate profit or cost savings. A wealthy individual who cherishes his money would never make an investment in anything, anyone, or any company without first knowing the expected return. Before making any investments, it's common for them to ask this question, mostly because they want to know what to anticipate. Poor people typically don't invest at all, and when they do, they hardly ever conduct thorough due diligence. I took my business offshore. In a politically and economically secure climate, a tax haven is a nation that gives foreign firms and individuals little to no tax liability for their bank accounts. They provide tax benefits for businesses and the very rich, and it is clear that they might be abused in nefarious tax avoidance schemes. Tax havens can be used legally by businesses and rich people to store money generated abroad while avoiding paying higher taxes in the US and other countries. Tax havens may also be utilized unlawfully to conceal money from domestic tax authorities. This can be accomplished by the tax haven cooperating poorly with foreign tax officials. Recent years have seen an increase in the political pressure on tax havens to assist with investigations into international tax evasion. Rich people frequently choose to move their businesses to these tax havens, either to completely avoid paying taxes or to pay as little as possible. They also enjoy relocating to tax-free locations. A prime illustration of this is the move to Monaco of all the Formula One drivers and other celebrities. Because of this, only the wealthy would relocate the majority of their business to tax havens and offshore locations. Values are very important in business. Values are essential and fundamental ideas that direct or inspire behaviors. They assist us in deciding what matters to us. Values are the character traits we decide to live by to direct our behavior. They also characterize the type of person we want to be, how we treat ourselves and others, and how we interact with the outside world. They offer the fundamental rules of behavior. Values are only those things that are right, preferable, or worthwhile. The driving force underlying meaningful activity is values. They take on many different shapes and sizes and are the goals for which we strive. Personal values are opinions on what is morally right and wrong that may or may not be regarded as such. Cultural values are those that are upheld by cultures or faiths and represent what is significant in each situation. Ethics depend on values. Human acts and the decisions made in making those acts are the subject of ethics. Ethics assesses those deeds as well as the underlying principles. It establishes which values ought to be upheld and which ought not. Courage is one of these values, as I covered in my blog post from last week. People who respect courage are prepared to defend their beliefs, even in the face of harsh criticism. When it comes to dealing with right and wrong behavior, courage is a moral quality. Rich people attach great importance to values. Most likely, they won't conduct business with those who don't share their principles and business ethics. Before they engage in or conduct business with someone or a firm, they presumably want to know what type of values they share. I inherited a hedge fund. Hedge funds are private investment partnerships and capital pools that invest in or trade in complicated assets, including listed and unlisted derivatives, using a variety of complex proprietary strategies. A hedge fund is, to put it simply, a collection of capital that engages in both short and long positions, buys and sells stocks, engages in arbitrage, and trade bonds, currencies, convertible securities, commodities, and derivatives in order to earn returns with lower risk. By using alternative investment strategies, the fund seeks to decrease risks to investor wealth from market volatility. High net worth individuals and families, endowments and pension funds, insurance firms, and banks are common types of hedge fund investors. These funds operate as offshore investment corporations or private investment partnerships. They are exempt from periodic NAV disclosure requirements, as well as registration requirements with the securities market regulator. Rich people frequently leave hedge funds or invest in them for their offspring to inherit. You must have a specific amount of money, and if you have, you must be wealthy in order to be able to pool a hedge fund. Hedge funds also have been passed down via families to create wealth. Thank you for sticking with us until the end of the video. We would like to include one more phrase that only the rich use. The bank just paid interest on their loan. The fee you pay to borrow money or the fee you charge to lend money is called interest. The most common way to represent interest is a yearly percentage of the loan amount. The interest rate on the loan is known as this percentage. For instance, if you place money on a high-yield savings account, a bank will give you interest. The bank pays you to keep your money on deposit and utilize it to make investments in other deals. On the other hand, if you borrow money to cover a significant bill, the lender will also charge you interest. To an affluent person, interest refers to the profit they get from lending money, whereas to a poor person, interest refers to additional money you pay when you borrow money from a lender. And for the majority, you must be wealthy if you have enough money to lend big amounts of money to banks. Post any more queries or remarks in the comment area. Click the like and subscribe buttons if you enjoyed the video so that others might view it and be inspired. To ensure that you don't miss any new videos regarding personal development, enable the notification bell as well. I'll see you next time.